What if the reason you can't get ahead financially has nothing to do with how much you earn, and everything to do with a glitch in how your brain labels money? Most people never catch it. You're about to. Here's something uncomfortable. Two people can earn the exact same salary, live in the exact same city, and one of them is quietly building wealth while the other is perpetually broke. Same income, same cost of living, completely different outcomes, and the difference almost never comes down to discipline or intelligence. It comes down to an invisible mental trick your brain is playing on you right now, probably without you having the faintest idea it's happening. Economists have a name for it: mental accounting. The plain English version is this: your brain doesn't treat all money as equal. Even though every dollar in your wallet or your bank account is worth exactly the same thing, your brain quietly sorts money into invisible labeled buckets: fun money, serious money, found money, guilt money. And once it goes in a bucket, your brain applies completely different rules about how it should be spent. Rational economics says that's insane. A dollar is a dollar. It doesn't matter if it came from your paycheck, a birthday card, a scratch ticket, or a tax refund. It has the same purchasing power. It can buy the same things. But your brain, this incredible pattern-matching machine wired for survival, not spreadsheets, refuses to see it that way. And here's the part that should make you sit up. This isn't a character flaw. It's not laziness or stupidity. It's a feature of human cognition that every single person has, including people with finance degrees, including economists who literally study this stuff for a living. The question isn't whether your brain does this. It absolutely does. The question is whether it's costing you money you'll never get back. Spoiler, it is. Let's talk about exactly how. So let's get precise about the mechanism, because once you see it clearly, you'll start spotting it everywhere in your own life. The psychologist Richard Thaler, who eventually won a Nobel Prize partly for this work, observed that people mentally categorize their money and then apply different spending rules to each category. Think of it like this: your brain is running an internal bookkeeping system, except it's a deeply irrational one. It has separate ledgers for your regular income, your savings, your windfalls, your loose change, your credit card balance. And the rules about what you're allowed to spend from each ledger are completely made up, but they feel absolutely real and binding. Here's a simple demonstration. Imagine you find a $20 bill on the street. How do you spend it? Most people treat that 20 like fun money. They buy something indulgent, something they wouldn't normally justify from their regular paycheck. But wait. That $20 is identical to any other 20 in your wallet. Your rent doesn't know the difference. Your retirement account doesn't care where it came from. Now flip it. Your car breaks down and it's going to cost $400 to fix. You have the money. It's right there. But a surprising number of people will put the repair on a credit card at 18% interest rather than touch the emergency fund. Why? Because their brain says that money is in the wrong bucket. It's labeled. It feels wrong to move it. The bucket feels real. The label feels like a rule. And that feeling overrides basic math every single time. That's the mechanism. Hold onto it, because now we're going to watch it ruin someone's year. Jordan is 34, works in marketing, earns a decent salary, not extravagant, but genuinely solid. By any reasonable measure, Jordan should be building a comfortable financial cushion. But every January, Jordan has basically the same amount in savings as the previous January. The number barely moves, and Jordan genuinely cannot figure out why. Every spring, Jordan gets a tax refund. Last year it was just over $2,000. Not real money, fun money, windfall, and within 6 weeks it was gone. A weekend trip, a new TV that wasn't quite necessary, a few nicer dinners than usual. Nothing outrageous by itself. But the $2,000 evaporated because it never felt like real money to begin with. Here's the uncomfortable part. That tax refund is not a gift from the government. It's Jordan's own money, money that was withheld from Jordan's paycheck all year, money Jordan earned in February and March and April and handed over in advance. It's as real as any paycheck. But the mental label refund transforms it into guilt-free spending cash, and it goes the other direction too. Jordan has a gym membership that costs $50 a month. Jordan hasn't been to that gym in 4 months. That's another flavor of mental accounting, called the sunk cost fallacy, where Jordan treats money already spent as a reason to keep a subscription that provides zero value, because canceling feels like admitting the money was wasted. $2,000 in windfall spent carelessly, $600 a year in unused subscriptions kept irrationally. That's $2,600 in 1 year from one person's mental accounting alone. Multiply that across a decade with compound interest, and we're talking about a genuinely life-changing sum. Here's where mental accounting gets really insidious. And this is the part most people never connect to their own situation. You've probably heard the straightforward advice. If you're carrying high-interest debt, pay it off before you put money into low-interest savings. Mathematically, this is airtight. If you have a credit card charging you 18% interest and a savings account paying you 4%, every dollar sitting in that savings account is costing you 14 cents a year. You are literally paying to feel safe, but a huge number of people do exactly this. They maintain a savings account, sometimes with thousands of dollars in it, while simultaneously carrying credit card debt at 2, 3, 4 times the savings rate. What they are actually saying in the language of behavioral economics is, those two pools of money are in different buckets. They feel different. The debt feels like a separate problem in a separate mental ledger to be handled separately. But your bank statement doesn't care about your feelings. The math is the math. And this is where the twist lands hard. Mental accounting doesn't just affect how you spend your fun money. It shapes how you manage debt, how you invest, how you treat your retirement contributions. People will cash out a retirement account early, paying penalties and taxes, rather than tap a savings account they've mentally ring-fenced. They'll take a personal loan at 12% rather than sell an investment that's sitting flat. The buckets feel so real that people take objectively worse financial outcomes just to keep the labels intact. The glitch isn't in your spending. It's in the entire architecture of how your brain constructs your financial reality. Let's make this concrete and personal, because abstract mistakes are easy to dismiss. Imagine you fall into the most common mental accounting trap. Every year you receive some kind of windfall, a tax refund, a work bonus, a small inheritance, gifts. And every year that money gets mentally labeled as extra and spent on things you'd never buy from your regular income. Let's say that windfall averages $3,000 a year, modest, realistic for a lot of people. If instead you invested that $3,000 a year into a broad market index fund, starting at age 30, with a conservative average annual return of 7%, by the time you're 65, that habit alone is worth roughly $400,000. Not because you earned more, not because you sacrificed your lifestyle, simply because you stopped letting the label on the money determine how it gets treated. Now add the debt side. If you're carrying $5,000 in credit card debt at 19% interest, and you have $5,000 in a savings account earning 4%, the net cost of keeping those two buckets separate is roughly $750 a year. Every year, just an interest differential. That's not dramatic. That's just the invisible tax your mental accounting system collects. And here's what really gets me: these aren't extreme scenarios. These are ordinary, everyday financial situations that millions of people are navigating right now. The mistake isn't buying a yacht. It's treating a tax refund like free money. It's refusing to consolidate debt because the savings account feels untouchable. It's the small, structural irrationality that compounds quietly in the background for decades. Your future self is going to inherit whatever financial architecture your present self builds. And if the architecture is built on invisible buckets and irrational labels, the structure is going to have some very expensive cracks in it. Okay, so your brain does this. Everyone's brain does this. What can you actually do about it? The first move is the simplest and the most powerful. Make the buckets explicit and intentional. Right now, your mental accounting system is running on autopilot, stamping labels on money without your permission. The fix is to take control of the labeling. Write down, literally write down, every pool of money you have and what it's actually for. Not what it feels like it's for. What it mathematically should be for given your actual priorities. When you get a windfall, a refund, a bonus, anything that triggers that free money feeling, pause before you spend a dollar of it. Ask one question: if this had come in my regular paycheck, would I spend it this way? If the answer is no, your mental accounting is making the decision, not you. Second, if you're holding debt and savings simultaneously, run the actual numbers. Get the interest rate on your debt. Get the interest rate on your savings. If the debt rate is higher, which it almost certainly is, you are paying money to maintain the psychological comfort of a savings label. That's a choice. It might even be a choice you keep making, because some people genuinely value the emotional security of a savings buffer. But make it consciously, with the real math in front of you, not because the buckets feel different. Third, automate across bucket boundaries. Set up automatic transfers that move money before your brain can label it. If your bonus hits your checking account, have a rule ready before it arrives: 20% to debt, 30% to investments, 50% free to spend. Pre-decided rules bypass the labeling reflex entirely, because the decision was made when you were calm, not when you were excited about found money. You will not eliminate mental accounting. Nobody does, but you can make it work for you instead of against you, and that gap, compounded over decades, is the entire difference between the two people at the start of this story. Mental accounting is one of the quietest and most expensive things your brain does with money. Now you can see it. Your money brain doesn't switch off when it comes to retirement. That's exactly where these biases cost the most. I built a free tool that shows you the real math, no spreadsheet required. It's called Granary, links in the description.